Hello and welcome to the Risk Talks. Today we would like to talk about a very new risk which appeared on the global risk map recently. I mean greenwashing risk. In the past 2-3 years, we saw many cases of greenwashing practice which made headlines in media. ESG experts, investors, regulators, policymakers start to discuss these issues which actually could impede our journey to the net zero finance. To talk about greenwashing risk, today we invited Mark Azoulay. Mark is a partner at McKinsey Company based in London, and he leads the firm's sustainability work with a financial institution. Mark has worked with more than 20 banks globally across strategy, risk, and decarbonization. And today, he will share with us some insight about greenwashing risk. Mark, thank you for joining us and welcome. Very nice to see you. Welcome to the Risk Talks.
Thank you again. It's a pleasure to be here.
Okay, so let's start. And first of all, I would like to ask you, what is a greenwashing risk and why it's so important now to tackle this issue?
Yeah, so it's a great way to start. So the industry's definition of greenwashing risk is the practice of trying to get an unfair competitive advantage by marketing green products while actually not all the requirements or all the environmental standards are met. So this is the official definition that is typically used in industry. And the reason this is important is because not doing this well can create reputational and potentially litigation risk for banks. And actually, over the past year or so, we've already seen 3 regulatory investigations in banking across Europe and North America. So you can see how this can create risk for banks.
Okay, so what actually, if we go for the look at details, what actually did create this greenwashing risk for banks?
So in a nutshell, what creates greenwashing risk, or when greenwashing risk is at its highest, is when banks make a lot of announcements and the supporting information or the controls around those announcements are suboptimal. So this is, in a nutshell, what is creating the risk itself. So if we take those in turn, the first one is that banks are making today a lot more announcements than a few years ago. That's the reality. So for instance, if we take the United Nations Net Zero Banking Alliance, there are more than 120 banks that have now committed to neutralize their financed emissions by 2050. And that's quite significant in terms of announcement because it represents, in Europe, for instance, between 50 and 60% of banking assets. So it shows you the level of magnitude of the commitments that are being made. Another example is if you take the recent autonomous report, they looked at the top 50 banks globally and the commitments they made on green finance. And overall, it's about 10 trillion of assets of green finance that have been committed, which in the context of the entire banking industry, which has about 160 or so trillion of assets, is slightly less than 10%. So again, quite significant volumes are being committed to that. And on average, when we looked at some of the banks in the industry, it's true that they make references to sustainability much more often than before. So for instance, in annual reports now, we see the word sustainability or ESG being used more than 200 times in some cases in their annual reports. And on average, banks have issued, or the leaders in sustainability have on average 8 products or so in their portfolio. So you can see that the amount of commitment has really scaled up and it's quite significant. and that creates
indeed.
the first
That's
driver of it.
very interesting statistics and very interesting cases. Thank you for sharing this. And about the second point.
Yeah. So the first point is there's banks are saying more, are committing more. The second point is how good is the information supporting those commitments, and what we find is that there are still a lot of challenges with that. So, for instance, banks are very cautious not to create products that will have unintended consequences and creating unfair lending, etc. The second point is also that data scarcity and data quality is still very much a challenge for several banks. And the models that are being used to some extent are relatively new and sometimes not validated. So the level of information that supports those commitments sometimes is less robust than what banks are typically used to do. And also the controls around those announcements can sometimes be suboptimal. So for instance, the European Central Bank, in their latest supervisory exercise back in November, they found that actually less than 5% of banks had ESG in their disclosure policy. So it shows you that the level of controls can be also improved.
Yeah, that's very interesting, Mark, and obviously the risk is quite high for banks. And so in this context, what can banks do exactly to manage greenwashing risk and to reduce this risk in the near future?
Yeah. So the good news is that a lot of what the banks can do is can rely on traditional approaches of risk identification. A lot of the traditional approaches can be leveraged, and there are some guidelines as well from the regulators on banks on what banks could potentially do. And there are some emerging practices in the market that are quite interesting. We've seen, for instance, some banks using a voice of the customer approach or voice of the stakeholder to identify what are the sensitive issues, where whenever they make an announcement, those are the ones they need to substantiate and be more thorough in the information they use to make those announcements. We also saw some banks develop a very robust sustainable finance framework, which basically classifies what is considered green and what is not, so that whenever they make some commitments on green products, for instance, it's very transparent what they're considering as part of those commitments. And we've also seen some banks develop very robust controls. There's one institution in particular that, before making their announcement on their financed emission targets, they went through a very lengthy and thorough process of validation by various stakeholders, including audit. So we are starting to see some interesting emerging practices. And again, as I said, the good news is that most of it can rely on traditional approaches that banks are used to in any case.
Yes, indeed, and that is very optimistic. And let's end up on this optimistic note. Thank you, Mark, for sharing your insight with us. Very nice to see you.
Very nice to see you too, and thank you very much for the opportunity, Evgeny. And for the audience, feel free to reach out if you have any questions or want to discuss the topic any further.
Thank you.